Every year, compliance regulations change thousands of times, and every year ADP makes thousands of seamless platform updates so businesses can focus on everything else, like running their business. Grow stronger with ADP, HR, talent, time, and payroll.
Investors Chronicle.
Welcome to the IC Interviews. I'm Lenora Walters, and joining me today is Nick Greenwood, Manager of Miton Global Opportunities. This investment trust invests in other listed funds rather than directly in equities, and its holdings include funds which invest in esoteric and quoted assets. Nick has run Miton Global Opportunities since 2004, before which he held a number of other roles in fund management and stockbroking. Miton Global Opportunities has performed strongly against global equity indices and investment trusts and other multi-asset investment trusts over the past 12 months. What's been driving this performance?
I think one of the overriding factors is that during the crisis and in the aftermath, we looked at the amount of fiscal and monetary stimulus being pumped into the markets, and with hindsight, wrongly considered that that the pandemic would be relatively over quite quickly, and that people would be coming back to the economy with a phenomenal amount of stimulus in the background, and that would drive equities higher. So part of it was that we were fully invested and slightly geared in that period, and going into what became quite a strong bull market. Given that we look for overlooked and unloved situations and looking for pricing anomalies, these sorts of conditions and tumultuous conditions that we had a year or so ago chucked up a lot of opportunities, and the biggest winner was something called River and Mercantile Microcap. There had been a period post-Woodford where the received wisdom was to avoid anything with a small market cap, and therefore they were desperately out of favour. We'd managed to pick up a line of stock at a 34 discount. I think what the market had forgotten, they have a structure to stay small and flexible so they can invest in the smallest companies listed on the stock exchange. That basically means that once they go over 100 million, they hand money back to shareholders at around NAV. And therefore, we bought it at a very steep discount, performed incredibly well in portfolio terms, and an enormous narrowing of the discount, which allowed us to redeem quite a lot of our holding at around NAV. There are other sort of interesting small things. There was individual stock, Baker Steel, which does private equity in the mining world, obviously did very well during the period of stimulus. And a couple of sort of special situations, EPE Special Opportunities, just performed extraordinarily well. And Dunedin Enterprise, which is a private equity trust in a very orderly wind down, has had some great results. So a wide variety of reasons why it might have been quite a good period. I think generally speaking, though, because there are, the investment trust sector, the closed-ended sector, is becoming a home for alternatives. There are so many asset classes that are being attractive, and in recent days we've had a hydrogen trust, a space trust. There's a phenomenal amount of asset classes. So there's always something coming in favour and out of favour, which is when we tend to make the returns. And the fact that it's so much more varied now means there's always something coming out of favour, and therefore part of the factor that it's done so well is just any trust doing this and following this strategy probably will be doing better now because there are so many more opportunities.
I suppose just more broadly, what particular changes have you made to the trust over the past 18 months? And how have you gone about taking advantage of these investment opportunities?
Well, we added quite a little. I mean, River Mercantile wasn't the only microcap. We bought a basket of microcaps. I mean, you had a bombed out underlying asset class, and you had, in some cases, companies trading on 6 or 7, 8 times earnings, but you're buying them in a package that traded on a steep discount. So that was an area that we added to. We're always looking for situations where there's a macro view that we're positive about, but also a special situation. So we've been topping up exposure to Vietnam. What we have there is that as a country, it's a big beneficiary of the trade war and of COVID, because multinationals now want to diversify their manufacturing and their supply chain, so they don't have all their eggs in the Chinese basket. So, that's a view I think will gain greater acceptance. But the special situation element there is that going back to around 2005, Vietnam briefly was one of the hottest investment stories on the planet. There were a number of investment trusts launched at that time, which raised very large amounts of money. And the legacy of that is that the two investment trusts we own are FTSE 250 stocks in their own right to this day. That dwarfs demand for Vietnam, which explains why they trade on such wide discounts. But as that macro view gains acceptance, that will trigger demand for their shares. And the boards of both trusts recognise the oversupply situation, so they're buying in on a regular basis. So, we expect a tipping point in the not too distant future where that very wide discount will tighten up fairly spectacularly at a time when the macro view is generating portfolio growth as well. But the sector, as I said before, continues to evolve, and therefore new sectors that we've got involved in: shipping, mixed and light industrial units, and tech disruptors.
That's obviously some examples of the things you have added. What have you recently sold or reduced?
Probably a couple of examples. I mean, everything comes in and out of favour at some point, and a couple of departures over the last year: Augmentum FinTech and Biotech Growth. Both stocks we were able to pick up in the COVID disruptions very, very cheaply. And it's difficult to think back that two sectors that have been quite hot could have been out of favour to that extent. But they've come back into favour, and we've taken profits on the very large gains because those stocks are no longer so out of favour. And those were both very successful investments.
Now, Micron Global Opportunities has had a good run recently, but there are years when it doesn't outperform broad global equity indices. What are the reasons for this?
One of the reasons is it's less and less about equities. Equities are now less than half of the sector, and if you look at the portfolio, a lot of the asset classes are a long way detached from equities. I think over 5 years we're probably around the same as the world index, and that's been an index that's been very difficult to match over that period. So we're very pleased to have matched it because so much of that the indices growth has been in the mega cap growth stock. Had a very flat 2018, 2019 because the market focus was so on those narrow range of stocks. And as we articulate our strategy being looking for the overlooked and unloved, that would have been style drift on a humongous basis if we'd gone running off and chasing something totally different. So we were pretty well static because all our unloved and overlooked stocks stayed exactly that way. But of course, the progress that they were making during that period was reflected in their share prices more recently, as obviously you can see in the numbers.
And are there any particular types of market conditions in which Micron Global Opportunities outperforms and types of market in which it underperforms?
I think that the underperformance we talked about was if you've got, it's an unusual situation where you've just got one sector that was in vogue. And it wasn't really that, it was the opportunity cost rather than we were losing money or anything like that. I mean, I think the shares remained fairly static during that period. I think it's just, as I said before, you just need things to be coming in and out of favour. And that really is more likely to be happening now because of the wide variety of sectors represented than they would have done in the past. So I think, not something we've engineered, but we just sort of find ourselves in the sweet spot of a style that actually it's well suited to the environment we find ourselves in and what the closed-ended world has evolved into.
Now, you benchmark against sterling overnight interbank average plus 2%, which is essentially cash. Do you think it's a fair comparison in view of the fact that you invest in potentially higher returning assets, albeit a lot of them aren't listed equities?
I mean, going back to the origins, and I think we tried to float this in 2003. We ended up launching in 2004. What we really wanted was we wanted to have a benchmark or a style that basically said we'd invest in something we think we're going to actually make money in it, rather than trying to closet track an index. And you've got to go back to that era. You may remember Vodafone taking over management and becoming 14% of the index as a result. Now, if you interviewed, and I did interview a number of UK managers over that period, and if you ask them which stock they disliked most in the market, they correctly, given what happened afterwards, identified Vodafone as the one they were most bearish on. But a fund manager in that era would identify a very bearish position by maybe taking 10% 10% weighting relative to its 14% weighting in the index. Now, in the real world, if you're a financial advisor, would you sit down and say to your client, well, I've put 10% of your life savings into the shares I think are going to fall the furthest? That's the world we lived in, and we really wanted to break away from that, and we only want to invest in things if it actually makes a return. I suppose it's what, at the time, would be called absolute return investing. Unfortunately, absolute return investing has come to mean something very different. We won't lose you money in any market environment, and we're perfectly capable of losing money in various market environments, and therefore we've dropped using that term because it doesn't mean what we set out for. So yeah, I mean that's what we're trying to achieve. And of course, if you're trying to achieve that, it's very difficult to know what sort of index you would venture again. So we've agonised it for years, but the trust has been around nearly 20 years, and we've never really come up with a better idea. But I think people are familiar with what it is we're trying to do. We are trying to make absolute money, not trying to beat an index or whatever.
Out of interest, roughly what percentage of the trust assets are unquoted assets and what percentage on, I suppose, listed equities? I suppose if you're looking, I'm not thinking of the trust themselves, thinking look through to the underlying assets.
Well, the equity is probably in the minority now. Yeah, I mean, but it would be things like Indian equities, UK microcap. I mean, we often quote probably about 40%, but that figure has probably drifted lower. I haven't done the numbers of late to where the underlying is listed equity, but it's a minority, and that will shrink naturally as equities become less important. We'll continue to lose the odd equity fund from our universe, but continue to gain new asset classes. As I said, we had a hydrogen trust successfully launched this morning, but lots of the old school trusts, if they can't reinvent themselves, are often just disappearing.
You see trusts trading at a discount to net asset value, which looks like it has the potential to narrow. How do you work out which trusts' discounts will narrow? What catalysts and signs do you look for?
Difficult to generalise. We talked about Vietnam opportunities. There, we just expect greater demand and fewer shares. That is the catalyst, and we can see that that's actually happening bit by bit. Where the tipping point comes, that gets to be a bit of an inexact science, but we can see the way it's going. River and Mercantile Microcap we spoke about earlier, that was identifying the mechanism that returns money to shareholders that the market seems to have completely forgotten about. And that's a mechanistic situation that will be triggered. Others, Dunedin Enterprise, it trades on a wide discount, but every asset will be sold and the money handed back to us at NAV. And it's similar in the second-hand life policies fund is a similar situation. As those policies mature, money will be handed back, and therefore our returns will come bit by bit, but the payments we get will be at NAV. Other times, a good example, there are a lot of family-controlled trusts, and for years and years you wouldn't have touched them because they always traded on wide discounts. But I think a number of these things we're seeing generational change as a sort of the big shareholdings move from one generation to the next. They might want to do things in a different way, and that for example can be a catalyst for change. So it's very difficult to generalise.
What would be an example of one of these family trusts you're referring to?
Well, one that we had was Establishment Trust, for example. When the patriarch died, there was a bit of a family war, all ended up in High Court, and the shares were all distributed around various grandchildren, for example, which brought around the end of the trust. Another one, that we hold in the portfolio now is Hampshire Trust. It traditionally trades on a very, very wide discount. But, reaching the point, and it won't be the next day, week or months, that, there will be a generational change there. It's a very small holding at the moment, and when it has a bad day on the markets and it gets harshly treated and drifts to a 35 discount, we collect a few. That's one where there will be change, and there are already signs of change in that one of the Brazilian subsidiaries has been redomiciled from being, I can't remember where it was domiciled before, but somewhere like Bermuda, to being a Brazilian company, which attracts the local buyers who weren't able to buy the existing vehicle. So yeah, that's another example. But there were quite a few of these. New Star Investment Trust is another one we have in the portfolio, which this morning, there was the announcement that Embark has been sold to Scottish Mortgage, so which it was a significant shareholder in. So yeah, that's just one example. But it's difficult to generalise. There has to be a catalyst, but there isn't one type of catalyst. They're all very, very different.
Okay, and I mean, how long are you prepared to wait for a trust discount to tighten?
We normally assume the natural cycle is about 18 months long. Further out, you get a bit of advantage. The market's not expecting anything for the next 2 years. For many fund managers, 2 years is effectively never, because we are judged on such short-term bases that actually that means the market, if we think the catalyst is a couple of years away, that means the market will be assuming it's never, and therefore we can buy in at completely the wrong price, as long as we're patient. And we do describe our style as watching paint dry. These things will get there in the end. And having that ability, and because we're closed-ended, to stay with these situations until the natural time to sell them comes to pass, we are allowed. That does allow us to have punchier positions in the investment trust than we would be able to if the managers are allowed to have in an open-ended fund, for example, where you've always got to worry about redemptions and having to hand money back to shareholders at 24 hours notice.
I mean, what would be a recent example of a trust which really successfully tightened its discount, and how long did it take?
Third Point's probably a good example. It's a feeder into a US hedge fund. We bought it on about a 30 discount. Today it trades on about 11. There, I probably much of the tightening of the discount is to do with recently improved performance. It was a turnaround situation. The lead manager had gone off to a life of philanthropy. COVID had rather spoiled that because his sort of protege had a difficult COVID, so the manager came back and took over the reins. So it was part turnaround.
I didn't catch the name. Sorry, was that?
Third Point.
Third Point, yeah. Okay,
Third Point, yeah. But more recently, they've been requisitioned because it's been trading on a wide discount. And very often, if you consistently trade on a wide discount, the real world will come in and try and take those assets. And that's, we've had a requisition on Third Point from the old British Empire, and that's helped narrow the discount quite sharply.
Now, what would be an example of when you got it wrong and things didn't work out well, and what did you do about the trust?
Oh, I'd love to say that we never get it wrong. The ones that have gone wrong, because we tend to slowly work our way into a situation and sort of say, well, we dip our toes into things and buy a few shares, because if it turns out to be an acid bath, we've only lost a toe. So a lot of the things that have gone wrong, we haven't had much exposure to. Don't think anything that's been sizable has gone wrong. Examples would be Astiana, which is a property specialist in Vietnam and in Malaysia. The Malaysian market, until recently, has had a difficult time. They had a particularly problem with a resort where fundamentalists were coming across on boats and, in one case, beheaded tourists in a McDonald's, which was not good for occupancy levels. There, jointly with other shareholders, we've just moved the thing into an orderly wind down, and the assets will be sold and returned. And that's often what happens, that if you trade on a very big discount and there isn't any way forward, the thing gets broken up, and therefore you get an uplift. So if you buy into something that's out of favour and then it underperforms from there, then very often, if it was trading on a 20 discount and then you get underperformance of 10% and the thing gets broken up and you get back at NAV, you've actually marginally made money out of a failure. So that's the typical sort of situation. But Astiana is one that's moved into realisation. One that we sold out of was LMS. It was managed by Gresham House. It was family controlled. They decided to take the contract back from Gresham House and for the family to manage it themselves. That didn't look a very satisfactory situation, but we were fortunate in that we were able to sell that one very quickly in the market. We took a view very quickly and got out while there was still some demand. So sometimes you just sell and move on because there's nothing you can do in that situation. You haven't got enough power in that situation to actually have any influence on the outturn. Very often, and some of our big winners over the years have been where we put a toe into a situation and it hasn't gone well, but you are looking at it, and as the situation moves on, there is a point in time where actually you become quite bullish. And Marwin might be an interesting example of one that's had a bit of a tough time. The model is to take a listed shell, inject assets into it. Recently had a successful run with the old British car auctions. But they've had a few aborted trades. The costs of doing this in a listed environment been prohibitive, and therefore they're now the next generation will be unlisted. The other thing that's happened is that the managers themselves have bought a lot of shares off of Invesco, which held a large position. It was in the Mark Barnett funds. Invesco obviously wanted to move on and shift that position. A lot of that stock has ended up being owned by the managers themselves. And I think that's just an interesting situation where the managers are now very much on board, owning the same bit of paper as yourself, and having addressed what went wrong and finding out a better way of doing things. That's one that we might consider actually staying with, and actually, if there were opportunities, maybe picking up a few more shares.
Are there any investment trust areas or particular types of investment trusts that appear to be offering particular value at the moment?
Difficult to generalise. There isn't. I suppose the most recent theme that's come in is trusts with high OCFs, because the recent legislation means that investment trusts now have to declare all the underlying fees, and also wealth managers do as well. There are some trusts, particularly the private equity area, where the fees are very, very high, and the reaction has been by many market participants just to sell. And we do love situations where people are selling to us for non-investment reasons. And a lot of these private equity trusts, and the two ones that we own are Oakley and NB Private Equity, they're performing very well at the moment, and therefore you've got sellers, but a sharply rising NAV leading to quite wide discounts, which may get wider yet. But the sellers are selling because they often don't get the opportunity to discuss with clients why their own expense figures are looking high, and therefore they just see a number and they have to sell it. So that's creating a lot of selling in that area. So that's a recent theme that's gone into the portfolio that looks quite interesting at the moment.
I mean, on that note, you're obviously not investing in direct assets, you're investing in other funds, and funds, like you say, charge fees. I mean, to what extent do you take the fund's fees into consideration when deciding whether to put your money in them or not? And I mean, how much do fees generally eat into Miton Global Opportunities returns?
I suppose sometimes we feel that we're renting situations rather than, we are a special situations investor rather than a multi-asset investor. So sometimes if you can see that the share price, going back to the third point example, which was at 30, now trading at 11, in a relatively short period of time, the NAV has risen quite sharply, and that dwarfs whatever fees would have been charged for that period. It's worth bearing in mind that our performance is after all fees. These fees, although they've only recently, the methodology has only recently meant that those things appear or are declared. They've always been there. These are not new fees, and people aren't paying higher costs. And of course, all our numbers and the performance that we've had over recent years is coming after fees. So yeah, I mean, so the underlying performance will be that much stronger. But as for us looking at fees, I suppose the biggest thing at the moment is the disruption that it's causing, as I've just described on the private equity fund. So actually, the fees element and the factor has actually led to the newest theme within the portfolio.
I suppose on the flip side, are there any investment trust areas that you're concerned about at the moment and perhaps avoiding or even reducing if you have exposure to them?
Well, we tend to look at what we own in a lot of detail, so we don't tend to look at the stuff that looks unattractive. We know vast amounts about small amounts of the market, but looking elsewhere, probably the renewables and that sort of area, which have a hell of a lot of issuance. You do worry that if they ever fall out of favour, the shareholder bases are quite narrow, and the regular names and those types of shareholders might all move in the same direction at once, and that is what could trigger the trading out at a wide discount. So, not an area we're looking at particularly closely because they're not at the moment unloved and overlooked, but the large amount of supply might trigger that sort of scenario in the future. But certainly nothing that we own we're worried about.
Yeah, I mean, what would be an example of such an area at the moment?
Well, as I say, probably infrastructure, renewables, those sorts of areas that have had a lot of issuance and have been regularly issuing shares over the years. Those would be, you could see that sort of scenario developing in those areas. It's obviously not something that's happening at the moment, but it's just you can see the potential.
Now, Miton Global Opportunities is going to offer its shareholders an opportunity to tender their shares later this year. Do you think many investors will tender their shares?
I think if the tender was happening at the moment, no. I mean, it's obviously a few weeks away, and the price you get in the tender would be less than just simply selling your shares in the market. So if people want out, because we trade so close to par, you can always deal in the market. So I think for this year, it's unlikely to see it shrink. Having this sort of structure, it shows that we care about the discount. We do buy in and we do issue shares so that people are comfortable in the fact that, we recently bought in some shares at a 1% discount. This process means it does give you the scope to grow the trust, where if you were sat languishing on a 15 or 20% discount, you would probably be fairly stuck. And since we introduced this and we brought in Frostro to help us on the marketing, at that point it was a £39 million trust. Today it's a £100 million trust. So it does allow you to grow. Hopefully getting from 39 million to 100 million is the really, really difficult bit. Getting from 100 million to 200, still very difficult, but maybe not quite as difficult, because once you're a little bit bigger, there will be a few more people that will consider you.
Mighton Global Opportunities, I suppose these days is considered relatively small. It's got assets of 100 million, which sounds a lot, but it's a lot less than some of the big trusts. Doesn't doing frequent tenders exacerbate the size problem? And are you looking to do anything to grow the size?
Well, as I said, it's grown in recent years. As I said, 100 is a lot bigger than it was, and therefore, the structure that we have does allow you to grow at times. If you're trading around par and there's a shortage of stock, and if people want to buy, then the only way that happens is via issuance. So the structure does give us the scope to grow. As I said, it is, although still small, it's a lot bigger than it was.
I mean, that's all my questions. Are there any points that you want to add?
No, I think we probably briefly discussed it, but I think the most important point is the evolution, the change of the sector, and how many more asset classes are in the sector than there were even 2 or 3 years ago. That means that the opportunities for Mighton Global are vastly higher than they were even 3 years ago. So I think that change, becoming a natural home for alternatives, is probably the most important thing. And I think that's been spurred by the debacle we've had in the open-ended property funds, that people now recognise that probably the best route or the best structure for asset classes where the underlying assets are not easily traded is the closed-ended fund.
Thank you, Nick. Some really useful pointers on how to select investment trusts and helpful update on Mighton Global Opportunities.